The increasing regulation of cryptocurrencies is becoming one of the most important developments in the financial world today, as the market for digital assets has surged. With over 20,000 different cryptocurrencies in circulation and a total market capitalization that peaked at around $3 trillion in late 2021, governments and financial regulators have taken a more aggressive approach toward overseeing this rapidly growing industry. Cryptocurrencies, once considered niche and speculative, are now mainstream, with major corporations like Tesla, PayPal, and even nation-states like El Salvador adopting or integrating them into their financial systems. However, this explosive growth has brought significant risks, including concerns over market volatility, consumer protection, financial crimes, and potential threats to monetary sovereignty. Regulators worldwide are grappling with how to handle these challenges without stifling innovation in blockchain technology and decentralized finance. DeFi, the increasing scrutiny has led to new legislation, enhanced enforcement, and debates about the future of digital currencies. Governments are focusing on several areas, including taxation, transparency, consumer protection, and anti-money laundering (AML) efforts, while some countries are developing their own central bank digital currencies (CBDCs) to compete with decentralized digital assets. Why is regulation needed? Cryptocurrencies have been praised for their decentralized nature, which allows users to make transactions without needing intermediaries such as banks. However, this decentralized aspect has raised concerns about illicit activities, including money laundering, tax evasion, and financing of terrorism. The anonymity provided by many crypto platforms is a double-edged sword, giving rise to both financial freedom and the potential for abuse. Regulators aim to strike a balance between fostering innovation and protecting consumers, while also ensuring that cryptocurrencies do not become a haven for illegal activities. Global regulatory trends. Different countries are adopting varied approaches to regulating cryptocurrencies. Here's how some major regions are responding. United States. The U.S. has taken a somewhat fragmented approach to cryptocurrency regulation. The Securities and Exchange Commission, SEC, and Commodity Futures Trading Commission, CFTC, have been central players. The SEC views many cryptocurrencies as securities, which has led to lawsuits, such as against Ripple Labs for XRP. However, a more cohesive framework is expected, especially following increased calls from lawmakers for clearer rules. The Biden administration's 2022 executive order on digital assets signaled a significant step toward comprehensive regulation, focusing on investor protection, financial stability, and ensuring innovation thrives in the U.S. market. European Union. The EU has been more proactive, introducing the Markets in Crypto Assets Regulation, MiCA, which sets clear rules for issuers of cryptocurrencies and providers of related services. MiCA aims to create a uniform legal framework, protecting consumers while encouraging innovation. This includes regulations around stablecoins, a growing area of concern due to their potential to disrupt traditional financial systems. China took a more stringent stance, banning cryptocurrency mining and trading altogether. The country's central bank declared all crypto transactions illegal in 2021, primarily due to concerns about financial instability and environmental impacts from crypto mining. Other regions. Countries like Japan and South Korea have embraced more progressive frameworks. Japan's Financial Services Agency, FSA, was one of the first to regulate crypto exchanges, while South Korea's Crypto Transaction Reporting System ensures that all crypto transactions are recorded and monitored for suspicious activity. Stablecoins under scrutiny. Stablecoins, such as Tether, USDT, and USD Coin, USDC, which are pegged to fiat currencies, have also drawn attention from regulators. Since these coins are often used for trading and as a safe haven during market volatility, regulators worry about their potential to affect traditional monetary systems. For example, concerns have been raised about whether stablecoins are adequately backed by reserves, as their collapse could disrupt the broader financial ecosystem. As a result, both the US and EU have indicated they will impose stricter requirements on stablecoin issuers regarding transparency and reserve backing. Taxation and reporting requirements. Many governments are increasingly focusing on taxation when it comes to cryptocurrencies. The U.S. Internal Revenue Service, IRS, for instance, treats cryptocurrencies as property for tax purposes. This means individuals and businesses must report capital gains and losses from crypto transactions. With more stringent reporting requirements in place, platforms such as Coinbase are required to share user transaction data with the IRS to ensure compliance. Similarly, the EU's DAC7 directive mandates that crypto platforms must report user information to tax authorities. These moves signal a shift toward more structured oversight, targeting crypto as a source of taxable income and capital gains. Central bank digital currencies, CBDCs. Another significant trend contributing to the increased regulation of cryptocurrencies is the rise of central bank digital currencies, CBDCs. Countries such as China, with its digital yuan, and the European Central Bank, with its plans for a digital euro, are exploring government-issued digital currencies. CBDCs could provide a regulated, stable alternative to decentralized cryptocurrencies, and their emergence may lead to stricter regulation of private crypto assets to avoid destabilizing traditional financial systems. DeFi and decentralized exchanges. The rise of decentralized finance, DeFi, which enables users to access financial services such as lending, borrowing, and trading without intermediaries, presents another challenge for regulators. DeFi operates through smart contracts on blockchain platforms, making it difficult for traditional regulatory oversight. However, as the sector grows, so does the likelihood of increased scrutiny. Decentralized exchanges, DEX, like Uniswap and PancakeSwap are likely targets, as they allow users to trade cryptocurrencies directly without a central authority, raising concerns about money laundering and compliance with anti-money laundering, AML, and Know Your Customer, KYC, rules. Privacy coins and their challenges. Cryptocurrencies like Monero, XNR, and Zcash, ZEC, which prioritize user privacy and make it difficult to trace transactions, are also being scrutinized by regulators. Their ability to anonymize users poses a significant challenge to law enforcement and financial regulation. Governments may increasingly seek to either restrict or heavily regulate privacy coins in the future, potentially limiting their adoption. Regulatory sandboxes and innovation. Some countries are creating regulatory sandboxes, allowing blockchain startups and crypto companies to test their products in a controlled environment with reduced regulatory requirements. The goal of these sandboxes is to encourage innovation while ensuring that consumer protection and financial stability are not compromised. The UK, Singapore, and Australia are leaders in adopting such frameworks. Potential benefits of regulation. Despite resistance from some parts of the crypto community, increased regulation can bring benefits, including consumer protection. Regulatory frameworks could help protect investors from fraud, scams, and market manipulation. Market stability. Clearer rules could reduce the volatility of the crypto market, making it more predictable for both investors and businesses. Institutional adoption. Greater regulatory clarity could lead to broader institutional adoption of cryptocurrencies, as traditional financial players may feel more confident entering the market once it is regulated. Increased legitimacy. Well-crafted regulation could enhance the legitimacy of cryptocurrencies in the eyes of the public, potentially leading to greater mainstream adoption. Challenges and the road ahead. However, regulation is not without its challenges. Striking the right balance between fostering innovation and maintaining control will be key for policymakers. Overregulation could stifle the crypto industry and push activity underground or to more crypto-friendly jurisdictions. On the other hand, lax regulation could expose the financial system to risks, undermining market confidence. Moving forward, governments and regulatory bodies will need to cooperate internationally to ensure consistent frameworks, as cryptocurrencies are inherently global. Fragmented or inconsistent regulation could lead to regulatory arbitrage, where crypto businesses and users migrate to jurisdictions with lighter oversight. The increasing regulation of cryptocurrencies marks a pivotal shift in the evolution of digital assets. While the crypto world was initially built on the ideals of decentralization and independence from government control, the growing popularity of these assets means they can no longer operate outside the purview of traditional financial systems. A well-regulated crypto ecosystem could foster innovation, build trust, and create a more secure environment for all participants. But only time will tell how this balance will be achieved.